Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Wednesday, 17th September. Coming up on the show, the Fed is widely expected to cut interest rates later today. The big question, how many more cuts for 2025? China has told tech firms to stop buying Nvidia's AI chips, that's according to the FT. And the UK and US sign a $42 billion tech pact to mark President Trump's state visit. So grab your coffee and let's own the morning. Well, the Fed is on the verge of its first rate cut of 2025. Traders are pricing in a 96% chance of a 25 basis point rate cut and a 4% chance of a jumbo reduction. But will it keep going? Now remember, we have a weak job market, sticky inflation, and of course pressure from the White House to contend with. One clue will come from the Fed's dot plot. This is a chart that's updated every 3 months and shows each official's prediction about the direction of rates. June's dot plot showed that there was consensus for 2 cuts this year, but back then there was perhaps more uncertainty surrounding tariffs, immigration, and the impact of taxes on the economy. We'll also be getting some housing data out later today. Economists are forecasting that housing starts to fall to an annualised rate of 1.37 million last month, while building permits are expected to tick up slightly. One person who had been calling for rate cuts for some time has been Senator Elizabeth Warren. But does she still believe that a rate cut is expected today? Well, she's been speaking to my colleague Jennifer Schoenberger.
So look, I've argued for 2 years now that I want the Fed to cut rates. I thought that inflation was well under control, headed in the right direction, and the Fed could bring down the interest rates. The problem now is that Donald Trump's chaos has so weakened the economy that we're watching the first signs of stagflation, and that is that inflation is tilting up and unemployment is tilting up simultaneously. The Fed, of course, only has one tool, and it uses it differently. If inflation is going up, it raises interest rates. If unemployment is going up, it lowers interest rates. And this is the box that Donald Trump has created. You know, I think there's something important to underline here, and that is the chairman of the Federal Reserve said last month that the Fed would have lowered interest rates last February if only Donald Trump had not created so much economic chaos. So the way I see this is one person right now is responsible for the high costs at the higher interest rates and for the increasing problems that we're seeing in the employment market. And that one person is Donald Trump.
But should we anticipate, do you think the rate cut is the right thing to do here, given what's going on the inflation front, given your concerns?
I think that Donald Trump and the chaos in this economy are backing the Fed into a box. I am really worried now about those unemployment numbers. I still want to see the Fed cut interest rates. But it would have been so much better to cut them when we had a strong economy and strong employment.
Well, the first thing you need to know about is breaking news out of China. The internet regulator there has told the country's biggest tech firms to stop buying Nvidia's AI chips and terminate existing orders. That's according to the Financial Times. This is seen as part of Beijing's efforts to boost its homegrown chip sector in order to compete with the US. ByteDance and Alibaba this week were told to end their testing and orders of the RTX Pro 6000D, Nvidia's tailor-made product for the country introduced just 2 months ago. Well, the ban goes beyond earlier guidance from regulators that had focused on the H20, Nvidia's other China-only chip widely used for AI. Meanwhile, TikTok's US arm looks set to be bought by a consortium that includes Oracle, Andreessen Horowitz, and private equity firm Silver Lake Management. The next thing you need to know about is that another IPO has been priced and will start trading today. Online ticket platform StubHub priced its IPO at $23.50. That was the midpoint of the expected range, giving the firm a value of $8.6 billion. Look out for the ticker STUB. Well, the IPO market has bounced back in recent months after an extended dry spell due to high inflation and rising interest rates. And the last thing you need to know about is President Trump's state visit to the UK. Well, to mark the event, the two countries have agreed a tech prosperity deal with an estimated value of $42 billion. Among the major investments promised, Microsoft says it will spend around $30 billion expanding cloud and AI infrastructure in the UK. Google's promised almost $7 billion in spending on a new data center and AI research. And Nvidia said it would deploy 120,000 advanced chips across the country. On the flip side, British pharmaceutical firm GSK said it will invest $30 billion in US research and development and supply chain infrastructure over 5 years. Well, to get into this in more detail, let's speak to Jace Terrell. He's CEO of Opportunity London. His organisation promotes sustainable investment into real estate in London. Jace, thanks so much for joining us. Well, let's start with how important this visit actually is in attracting new investment into London and the UK. Who are the winners and where's this going to actually create jobs?
Well, look, the US is our most important global trading partner for London and the UK across real estate, across foreign direct investment. So, look, it's a really important trip and probably will get a lot more traction on the trade side with this visit than perhaps on the other matters of foreign policy that are going around the world. So I think certainly there's winners in London and in the UK. And as you're just reporting, that investment by the AI companies and the R&D piece is really key for us. And I think in London, there's a huge supply chain and global talent that's based here that's going to benefit from that as well. So look, big numbers, big commitments, and we'll see the flows of that over the next decade here in London as well.
But if they're giving with one hand, with the likes of Microsoft and Nvidia and Google, they're going to take in return as well. So the UK is going to have to give up something here too. We've heard about GSK, but are there other UK firms that will have to do something for the US as well?
Yeah, look, I think that's all part of the bargaining at the moment. We've seen quite a shift even the last couple of weeks on some of this big pharma decision and what's happening there as well. But I think for London and the UK, some of the winning bits from our side, yes, it's the American firms scaling their investment here, but actually there's a huge amount of infrastructure that needs to be built out through that, whether it's power, resilience. And I think there's a lot of US companies that want to get more into the market here for the PPPs, energy space as well. So I think that's going to be an opportunity. I think the US is going to ride on the back of with these big commitments from these data and AI companies.
Seem to have noticed that the UK is trying its best to attract these big, well-known established companies to invest here rather than build their own firms from scratch like they do possibly in mainland Europe. Is that really the right approach? Should we not be focusing more on building here rather than trying to attract these mega companies from the US?
I think it's a mix. I'll speak more on London than the rest of the country, but we are the most globally traded city in the world in London. And I think it's a combination, as you say, of those inward investment companies growing here and attracting those. But there's also a huge push here to expand. And remember, London has, a number of unicorn companies, the most in Europe actually from here as well. So I think actually it's a dynamic marketplace of inbound and outbound that can only serve us better. I think other parts of Europe are having to work hard, obviously, to homegrown their companies of the future, where we're obviously a dynamic company of both import and export on that side.
IPO in New York, and in fact, it's been a pretty busy couple of weeks for IPOs in New York. Is it worrying? Is London losing its allure in attracting these IPOs in comparison to New York and, say, Singapore?
We've seen a shift for a while, haven't we, with the trend here? And I think the point is global capital companies, you have a choice, where they want to list, what the benefits are of that. I think we're very alive to that in London. I think the LSE understands this. I think a lot's riding, on the fiscal policy, budgets coming up for us here in the UK and those incentives. So I think there'll be a lot of eyes in the Treasury and the Chancellor, I'd imagine, looking at this and thinking about that. But I wouldn't rule London out. It's been trading for many, many decades, highly successful for a lot of those companies. And of course, from a real estate side where we sit, we are, as I said, the most traded global real estate city in the world. And we're sort of up nearly 20% on last year, and we'll hit about 15 billion this year in trade on real estate. So there's certainly winners from that bit of the market from our side.
Opportunity London, many thanks for your time.
Thank you.
Okay, we're going to be heading for a short break, but when we're back, we'll be looking at that idea that President Trump floated about ditching quarterly reports with my colleague Jared Blickery. Stay tuned to Market Sunrise. Well, among the biggest talkers in markets this week, there has been President Trump's push to ditch quarterly earnings reports. His rationale is that this will give more bandwidth to managers to run their company instead of preparing earnings calls. Yahoo Finance's markets and data editor Jared Blickery answers the question, what if earnings season only came twice a year?
What if earnings season only came twice per year instead of every quarter? It's a simple question with some big ramifications, and that's what we're exploring on today's Stocks in Translation. President Trump sparked the debate on Monday on Truth Social, saying that subject to SEC approval, companies should no longer be forced to report on a quarterly basis, but rather on a 6-month basis. He said, quote, "This will save money and allow managers to focus on properly running their companies." Now, first, let's break down what financial reporting actually is. This is the required scorecard, what a company earns, spent, owns, owes, and what's changed so that investors can gauge performance and risks. Importantly, this does not include expectations for the future or so-called forward guidance. Look-ahead targets and commentary are entirely optional, as they always have been. Now let's rewind the tape and start at the beginning in 1934, when the Securities and Exchange Commission got the power to require periodic reports. It wasn't until 1955 that they actually gave a timeline, which was every 6 months. Then in 1970, the 10Q was born, which had to be filed every quarter. This also happened in Europe. Then in 2013 and 14, European and UK companies, they got some relief and were allowed to step down to every 6 months. But not many took advantage. A few years later, a study found that only 9% of UK companies actually reduced their reporting. Finally, in our timeline in 2018, back in the US, President Trump asked the SEC in his first term to gather comments from the public on stepping down to 6 months in the US. At the time, many corporate leaders weighed in, including the Business Roundtable and then PepsiCo CEO Indra Nooyi. They largely favored cutting down the reporting to be able to focus on the long game. But the point is, this issue has been around for years. Now let's set the stakes. If we cut reporting to twice a year, we're essentially trading less corporate homework for less information. That can feel great in the C-suite, but how does it play for investors? Well, let's focus on the pros first. Fewer filings can mean lower prep time and costs, meaning less make-the-quarter scrambles and more time running the business. For cons, there are fewer timely updates for shareholders, as well as bigger information gaps, which can favor insiders and pros. And it can also make raising money harder. Think of it as the price of money going up when investors see less. Now, what does the research say? Let's dig into that. One study found that more reporting means smaller jumps in price when financials are reported, and that it led to cheaper fundraising. But another study on smaller companies in Singapore found that making them report each quarter lowered their market value due to the higher cost. Another found that stepping down from quarterly to semi-annual led to less analyst coverage, which can disadvantage smaller investors. And finally, a study found that less frequent reporting led to bigger information gaps. Translation, the average evidence cuts both ways. Smaller companies can struggle with the burden, but markets generally like timely information, and context matters. So what happens next? Here's your roadmap. First, watch the Long-Term Stock Exchange, or LTSE, which has been vocal recently and is expected to petition the SEC. It's backed by Founders Fund, co-founded by Peter Thiel and Andreessen Horowitz. Expect a pitch framed around long-termism, as the name would imply. Second, watch the SEC's path. The agency already gathered comments in 2018, and it could now go straight to a proposal, but it could also run another comment period. Third, watch for investor pushback. Groups that prioritize transparency and fairness, they're going to weigh in fast. If you manage other people's money, you want frequent comparable data. And fourth, keep an eye out for white papers. If rulemaking moves, expect think tanks and consultancies to drop fresh studies about cost, liquidity, and how often investors really need updates. The bottom line is there are big trade-offs here involved, but we're going to keep tracking this issue as it evolves now that it's got some steam in it again. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Time now for another break, but we'll be back with today's trending stocks, and there's a lot of movement today. Okay, first up, we've got General Mills. Now, you might be tucking into one of their cereals like Cheerios or Lucky Charms, but they've just reported earnings. And actually, the earnings beat consensus. Adjusted earnings per share came in at 86 cents. The markets were looking for 82 cents. And net sales actually came in at $4.52 billion, which was in line with expectations. But that's had very little impact on the share price in pre-market, just down there a little bit there. Now, for context, General Mills has been under pressure amid inflation pushing consumers to cheaper products and changing consumption patterns as people seek more healthy products. Pet food has been one bright spot for General Mills. And now we'll see how investors will react to these results, which follow aggressive cost cuts and new product launches. One thing that General Mills did say is that more people are choosing to eat at home. Okay, now you need to know that Workday, the enterprise software, is up more than 9% in pre-market. The company held an event for analysts yesterday and it announced some new plans, including snapping up the AI startup Sana. The growth plans got a thumbs up from activist investor Elliott Management. Okay, next up, a stock you want to watch closely, blockchain lender Figure. The stock is up again, more than 3% in pre-market after it jumped 30% yesterday and gave up some gains to close about 8.4% high. Actually, it's now up 4% in pre-market. Now, investors are loading their portfolios ahead of the Fed's decision today, and Figure is attracting optimism after what is widely seen as a successful IPO last week, in which it raised about $790 million. And while we're talking about this company, we'll also bring you a headline about another tech company called Figure. This one is Figure AI, which makes humanoid robots and is based in San Francisco. The startup is private, so harder to trade, but the news is that it has reached a $39 billion valuation after it raised over $1 billion in a Series C funding round that involved giant names including Intel Capital, Salesforce, Qualcomm, and Nvidia. Well, speaking of Nvidia, we've been watching news today that the stock is coming under even more pressure from China. So let's take a look at some key AI stocks this morning that are moving on US-China negotiations. For Nvidia, we're not seeing great giant swings. We can see that the stock is sliding again. Maybe there might be some profit taking there as the FT reports that a Chinese government entity has instructed leading tech companies to stop purchasing and even to cancel existing orders of Nvidia's GPUs. This comes on top of more bad news for Nvidia this week in China, where it faces an antitrust probe. And as Beijing steps up its pressure on Nvidia amid trade negotiations with the US, China's homegrown chip companies are gaining momentum. Look at Baidu. The Chinese tech giant is up about 16% in Hong Kong, and its Nasdaq-listed shares are up more than 8% in pre-market. That's after its in-house chip-making unit got an analyst upgrade. Meanwhile, Alibaba continues to gain ground, often dubbed China's Amazon. Alibaba is attracting new momentum with investors as it makes progress on its AI cloud expansion. It's up again more than 5% in Hong Kong today. And remember, this is one of the companies that have been asked to stop using Nvidia chips. So what's the outlook for Nvidia in China and what's next in the global chip race as US and China keep negotiating a new bilateral trade framework? Well, my colleague Josh Lipton spoke with Brendan Ahern, CIO of Crane Shares yesterday. Just a note that this conversation was recorded before the latest developments overnight.
This is a little bit of the art of the deal from the China side of trying to apply pressure where they can. And certainly Nvidia is very dependent upon China for revenue. They have a lot of operations in China. A lot of Chinese companies are very dependent upon Nvidia. So I think they're maybe trying to play their hand. The other thing that I don't think you can discount as zero probability is simply, the Chinese government is a bureaucracy with all these different government agencies, and it's feasible that the agency that put this out, the SAMR, State Administration of Market Regulation, they put this out maybe not even really knowing about the Madrid talks. I mean, I know that most people would say that's inconceivable, but it's something we've seen as students of China's government. It does happen on occasion where government agencies don't necessarily read the tea leaves and accidentally go against what the highest level of Chinese government is trying to accomplish.
A broader question, Brendan, that's asked on the show, and I want to get your take, is should the U.S. government even be allowing, Brendan, companies like an Nvidia or an AMD to sell AI chips into China? Some have argued no, full stop, that is a national security risk. Your thoughts on that?
I mean, certainly I think we all know that certain strategic industries, if it's semiconductors, steel, need to be manufactured here in the U.S. Just we saw the issues around supply chain during COVID, so it makes sense to manufacture some of this here. At the same time, should we be concerned about a chip that goes into your toaster that's made in China? I don't think so personally. I mean, I know this is getting harder because companies like a Sony with its PlayStation, or it's very difficult to understand what is that Nvidia chip used for. But I do think that the vast majority of these chips are used for really non-military purposes. And from the China side, they're not going to want their defense industry to be dependent upon U.S. semiconductor companies. So I actually think they've moved away from utilizing U.S. semis from a military defense purposes, just as the U.S. is trying to ring fence Taiwan semi with the Arizona factory for the purposes of our military.
Finally, Brendan, I want to get your thoughts on TikTok, that drama, because we had more news today. We had a framework apparently in place. Then we got new details this morning being reported. Brendan, you saw this. Apparently, the algorithm would be licensed to a new U.S. entity. I'm curious to get your thoughts on that headline. And were you sort of surprised by this, Brendan? Because I think some had thought TikTok was going to be just, kind of a part of a bigger, broader deal with China. But now it sounds like, again, reportedly, it could be just being kind of carved out here.
Yeah, I think we've been skeptical about a TikTok going to zero, just being turned off, because if you just go on ByteDance's website, which is just ByteDance.com, you can see that the majority of the investors in ByteDance, the actual control of the company, is predominantly U.S. and global private equity. So if you simply think about, if you make TikTok a zero, you're really hurting those investors in ByteDance, some very well-known U.S. and global private equity firms who are investing on behalf of your alma maters, endowment, your local foundation, your local pension fund. So I think you're seeing a solution that hopefully allows the original investors in ByteDance to be able to monetize that part of their investment via TikTok, as well as addressing some of the national security issues. And I would agree with Dan's point that the vast majority of what takes place on TikTok, if the Chinese government wants to know what teenage kids are, what their dance moves are, by all means have at it. I think some of this is blown a little out of proportion.
Well, sticking with tech, watch out for Meta's main event later, where they'll probably be highlighting their new AI smart glasses. Well, that's all we've got time for on Market Sunrise. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.